Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Wednesday, May 1st, 5:14 p.m. Eastern Time. Coming to you from St. Augustine Beach, Florida, with tonight's Revere Roundup Daily Market Insight video. State of the market, we are in a mild correction. See the trend gauge over here, some minor downgrades on the numbers, neutral. That's might be being generous with leaders as they underperformed today. And short term, two closes, at least two closes now for all five of the major indexes below the 21-day moving average. So that's just a pure red arrow. Same thing with the 50-day moving average, red arrow. Long term, all five of the major indexes still above their 200-day moving average. Remember, the market never gets into serious trouble until the indexes break below the 200-day moving average. Normally, that's around 10% off the high by the time that happens. Speaking about the S&P 500, but of course, leading stocks move two and a half, three times what the index does. So that's why we tighten our stops and keep any positions small while the wind is not at our back for leading names. So what happened today? Tight action into the 2 p.m. FOMC. A couple of some economic data that came out before the market, no major before the open, no major impact. That included the quarterly refunding announcement. And then as soon as the statement came out, the market started to rally at 2 p.m. Eastern time. Then Powell started talking and we started to rally even harder. Went from being negative to up a percent. And then as soon as he stopped talking, an abrupt reversal. Last 30 minutes were some pretty harsh selling. Still managed to close positive on the Russell 2000, mainly because banks were higher, also higher on the Dow and mid caps, but S&P 500 reversed to below the level when the statement came out at 2 p.m. and NASDAQ 100 taking it on the chin even harder. So FOMC initially a dovish rally, but then an epic failure as the dove was attacked by the hawk. Here are the final numbers. The 21 over 21, our leaders list down 1.66%, 13 out of 21 down, only six positive. The big eight, Microsoft, Amazon, Meta, and Google all positive, but Tesla down, Nvidia down, Netflix barely positive, but it ended up being about flat on the day, up 0.04%, basically flat. Apple also down, so kind of a mixed bag there on the big eight. Our G8, this is our eight growth ETF composite, not as bad as you might think, only down 0.13%, especially compared to the 2121 list. S&P 500 opened down 0.2, ended up round tripping that gain, closing down 0.33%, same as the equal weighted S&P. NASDAQ 100 down 0.7, about the same as the equal weighted NASDAQ 100. Positive close by 0.2 on the Dow, 0.1 on mid caps, 0.3 on small caps. Global 60/40 down just a bit. This was a matter of bonds being bid up, causing that gain to be causing it to be near flatline as worldwide stocks, BNDW, down by 0.26%. In-house GROTECTION, some of our leaders, SMCI reported last night and mixed results. They raised guidance for the full year, but missed a bit on sales. That cascaded over to several of the data center names that we own, and that hit GROTECTION down 0.7 on the day. We'll talk about the portfolio changes, also Bitcoin week and oils week, and we also own small pieces of those. We'll go through the portfolio as we always do. Let's start with the inter-asset correlation of the indexes along with bonds, precious metals, etc. So here's the S&P 500, this declining 21-day moving average. When we rallied, and this is quite an interesting rally. You can see the gap down, tight range, big rally up after 2 o'clock. In fact, we were discussing internally if this was going to be an O'Neill follow-through day, as we did get above 1%, stayed around there for about 30 minutes, and then boom, second waterfall close. This one even worse than the day prior, dropping from 50.90 all the way down to 50.20. Quite a fall. We're up mildly after hours. Um, we, as is typical, we rarely make portfolio changes after the FOMC comes out because it's prone to this type of volatility. And the only thing we did is trim a tiny bit of NVIDIA on the round trip. We trimmed some other things that when they were weak earlier in the day, but anybody that added on this rally up got their head handed to them, as that reversal is one of the harsher that I've seen. Sometimes, so now what happens is the macro people, investment committees will digest what Powell said overnight and decide if they want to bid the market up or sell the market off tomorrow. So it's very often that Thursday and Friday are the real move. But for now, anything apparently seen as dovish by the Fed was sold hard into the close. So there's the daily S&P 500, and more reason why when we're seeing this declining 21-day moving average and we're below it, to back off, which is pretty much our standard procedure. NASDAQ 100, same thing, failed into the 21-day moving average, also broke below yesterday's low and the 100-day moving average. Dow finished positive, showing some relative strength this week, but still also failing into the declining 21-day moving average and losing the 100-day and the 38,000 level. S&P mid-cap index failing at the 21-day moving average, still trapped below the 50 and 21, but above the rising 100-day moving average. And the Russell 2000, stop me if you've heard this, failing at the 21-day moving average. Also, that overlaps. In fact, it's breaking below the 100-day moving average on the Russell 2000. The 21-day declining moving average is. So failing at that 2000 level also, and still positive on the day, but in the bottom quarter of the range. So that's the 5 major indexes. The VIX, even though the market sold off, the VIX finished down on the day, but kind of did the exact same pattern that you would expect to see. So VIX down, VIX below 16. Seems a little low for the volatility that we saw today. US dollar. Dollar index, let's look at a 5-minute chart of this. It was basically flat to green early and then did the same thing, sold off and then rallied, inverse of what was going on in stock. So down on the day, but bouncing at the 21-day moving average and kind of consolidating, as you can see, for 2 weeks after this breakout. How did that hit the metal complex? Gold still below the declining 21-day moving average, but up 0.9% on the day. Silver below the 21-day moving average, also up 0.91% on the day. And gold and silver stocks, the GDX up 0.6, sitting right on the 21-day moving average. Bitcoin had a round trip today, gap down, and did the old rally fade along with the indexes after the Fed, but we did trim this and we may end up closing it out. We're down to a very small position in this. Actually, I did it again. There's BITO. I need to show IBIT as old habits die hard. But you can see making lower lows. We're watching this gap over here. We booked big gains on this, so although we're down about 10% on this last 1% of the position that we have, we booked 50% gains earlier on this. So it's a matter of giving back a little bit, but knowing that we booked up there and into this double gap support area here. we may give it a shot decided to sell half of it, give the other half a shot for another day. So that's Bitcoin. Let's go to bonds. BND, broad bond index. Wider range, higher high, higher low, closed inside yesterday's candle, basically flat. Positively on the day, 0.06%, which means rates were down. It was a bigger move on the TLT, as you can see here, up 0.4%. Price up means rates lower. Now remember, the bond index this closes at 3 o'clock. Rates were bid up a bit after 3 o'clock, but this shows it down 1.61%. That's the 30-year. The 10-year down 1.9%, still in this consolidation after the breakout. Actually, this is looking at a failed breakout. It's back into the consolidation before that breakout happened 4 sessions ago. So that's our inter-asset correlation. Let's go to the tail of the tape. You can pause this. One note about the FOMC and why it appeared to be dovish. First of all, they're in the process of QT, which is they're running off their balance sheet, which means they're selling bonds. They're slowing the bond sell-off from 60 billion a month to 25 billion a month, which means the market won't be as flooded with bonds from the Fed as it had been, which might tend to benefit the equity market. And Powell was asked some tough questions. People have been talking about stagflation. He said, I don't see either the stag or the flation. Market rallied on that. He also said it was very unlikely that a rate hike was going to occur, and the market rallied on that. But then, as I said, as soon as he stopped talking, all those gains were given back. So the day count from down 1 to down 2, second day below both the declining 8-day exponential moving average and 21-day moving average, with our negative expectations as long as we're under the 21 on the NASDAQ and the S&P 500. Sectors: gold and silver stocks, uranium, banks, and utilities up on the day. On the down, MSOS, this is the domestic marijuana ETF, which had a big pop yesterday, gave it all back, down 15% today, along with semiconductors and restaurant stocks. So in the portfolio, we sold FSLR earnings today after the close, and we had no cushion. So we cleared that out. It was a small starter position. And then on weakness, we trimmed IBIT and VDE, and then a bit of NVIDIA. This was that latest ad that we did, sold a third of that, reducing our exposure from 0.67 to 0.58. Bottom line on the day, the dovish FOMC rally gets attacked by bears, or was it hawks? I saw several people saying that really what Powell was saying was hawkish, and I heard dovish. I can kind of buy the reasons for it, but I think everybody came in with a bunch of a negative outlook on he was going to be incredibly hawkish, and that really didn't meet up to it. And by incredibly hawkish, I would say him talking about rate hikes, which he said, barring something drastic, he doesn't see that happening at all. But the bottom line is the bottom line, and the bottom line is price, and it reversed when he started talking, and we'll see what the reaction is by the market for the rest of this week. First Solar, we've also got a jobs report on Friday. That's going to be big. So you can see First Solar down 2% after hours. We sold it basically when it was flat on the day. It ran up above 180 afterwards. Still, basically, it's right on the 21-day moving average, now breaking it after hours. So we sold that. And we trimmed IBIT. I already showed that. We trimmed VDE as well. This certainly was not the 2-candle combination that we were looking for. Sold half on the break of the 50-day moving average, still holding on to the other half, but holding on to it loosely. And NVIDIA. So this had quite a roundabout day here. It was very weak early, and then it rallied, and then didn't meet near the lows of the day the way the indexes did, but it did sell off from 860 down to 830. during that pullback in the markets in the last 30 minutes. Now, looking at the daily chart of this, we trimmed the third because, well, it broke the 50-day moving average. Our reason for buying it back was this move back above that level. And our reason for trimming it was the break back below that level. There's pretty big support near that 800 level. Let's go through the rest of the portfolio. Cava, a leader, got hit today. Several restaurant stocks did. We'll talk particularly about Wing, which moved up, gapped up, reversed, and then reclaimed most of it by the end of the day. Another stock in the 21 over 21 list, Generac, reported initially gapped up and reversed hard and broke the 21-day moving average. Two names that had really good reactions to earnings with volume, gap up, Pinterest. That didn't flow through to Etsy after hours, however, as that is down 12%. And another one with a positive reaction was TMDX, which I mentioned last night, and that followed through for a 25% gain. And this makes it liquid enough now for us to take a look at it. On the downside, SMCI, I mentioned, the big sell-off when they didn't raise guidance. Well, we see now why they didn't raise guidance. They missed on sales, although they raised annual guidance, but pulled back, bounced at this 100-day moving average, which is right at the 700 level right now. So that is acting as support, same way it did back on 422. That move in SMCI triggered several data center names to be weak, including VRT, which we own, had been acting well after earnings. But volume, down 4.8%, not good. Volume, well below the 4 days when it rallied after earnings. Also hit ALAB. Down to the 21-day moving average. We bought this around 80, so we're down slightly on that starter position. And it also trickled through to weakness in Dell, another data center supplier, breaking the 21-day moving average, but on below average volume. We still own Spotify. This had a good day, closing right on the 21, up 1.5%. CEG, also data center name, down slightly on the day, closing right below the 21-day moving average. I mentioned ALAB, Vert, Kava, NVIDIA, IBIT, GDX, VDE. I hit everything that's in the portfolio. Let's go to the 21-21 and see the leaders and the laggards. The top 5 up on the day, CCJ, although it ran into the 21-day moving average and reversed. We already showed Spotify. Hood, which we stopped out of yesterday, ran into the declining 21. First Solar, we already showed that, and Datadog positive on the day. Look at how the moving averages are stacked up there, the 100, the 50, and the 21-day moving average. That has earnings next week. On the downside, we already showed some of these. Showed ALAB, showed Kava, showed Generac, showed VRT, showed NVIDIA, didn't show Micron, which broke the 21-day moving average down 2.9%. United Airlines reversed, but held the 50-day and the 21-day moving average, and CPNG down 1.3%. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. If you're interested in becoming a client, email my partner, Dan Stewart, dan@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. Why would you want to become a Revere client? Here's where we stand versus traditional pie chart advisors. As William O'Neill said, anybody can get you in. Who's going to get you out? It's the brutal bear markets that we avoid. In fact, you can see if you follow these videos how we pulled in the horns after the market started showing weakness, getting out of most of our names, holding only very tiny starter positions in some attractive stocks. Got stopped on some of those. If they're not making progress, we'll take small paper cuts on those. Compare that to the traditional advisor, which just sits there and bounces a tennis ball off the wall with the feet up on the desk. But you do get a nice little desk calendar at Christmas time. But if you're looking to preserve your downside, you're not going to get it. If you want it, call us at Revere, email or call. And with that, I'll wrap up the video for Wednesday, May 1st. Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.